economy, but it's since ceded some of those gains. Well, gold bulls and private investors seemingly shrugging off the biggest two-day price fall in the precious metal since the 1980s. The bulls insisting gold's reputation as a safe haven asset remains in play. What's the view of Brett Brocque from Brocque Capital? Well, he's live in Melbourne for you this morning. Brett, morning to you. One suspects so much still hangs on data as a driver, not least of all those unemployment claims out of the United States, because as we know, the link between those numbers and quantitative easing is undisputable. So how important is that next print when it comes to the price action?
Well, I think a lot of people, Carsen, have to understand what gold is first. And gold is not an investment. Gold is not even commodity. Gold's money. So gold doesn't go up, currencies go down, which gives gold its price. So a lot of people need to understand that gold made new highs in 2011 in US dollars. But in 2012, because of currency wars, it shifted. So then gold made new highs in euros in 2012. Well, 2013, gold's now made new record highs in Japanese yen. So gold's always up somewhere. If we focus the attention on the US dollar, yes, it's dropped. But gold's up in Japanese yen right now. So, you know, gold is holding its value against paper currencies. And the biggest thing that I want to stress to you know, people out there in the gold market is the price gets taken down in the paper markets, but in the physical market it's a very different scene. Because, as you know, markets are driven by buying pressure and selling pressure. So the more sellers there are, the price goes down. But the question is, who is selling? And in the physical market, people like India and Russia and China, central banks, and people owning the physical gold actually can't get their hands on it because there's 6 to 7 weeks waiting time at that. So when people are holding gold in my firm, I'm telling people to hold gold not as an investment, but as a competitor against paper currencies. And it just depends what country's debasing quickly where gold goes up in price.
All right, so when you say telling people, at what point does this become a bubble proposition alongside it? In other words, people holding it not treating it as one of those classic investment plays, as you say, but as you say, more alongside the view of paper currencies.
Well, first we have to understand what a bubble is and what a bubble isn't. And a bubble would be that everyone's rushing to it. Now,
it seems that a lot of them are doing that. People are queuing down corridors to buy bullion.
Absolutely, but it's still not bubble mania yet. The economic narrative out there is that everything's fine, you should be getting out of gold. Now, Carsen, I must have missed the memo out there that everything's fine when we've got the world's largest detonation going on. We've got a quadrillion dollars.
Well, you just set that up as a proposition to then disprove, did you not? Because who is really saying everything's fine?
No, I'm actually saying everything's not fine.
Yeah, exactly. But who would disagree with that?
Sorry, what was that?
No one would disagree with you, though.
Absolutely, but the biggest thing when it comes to understanding gold is that the paper price is dictating the physical price right now, and the sellers that dropped the market were institutional institutional sellers and hedge funds. These are people that have taken a paper position in gold that are highly leveraged, and the longs got smashed. So what's happening though is the physical market. It's different, and at the moment it's the paper market that dictates the price of the physical market. But you're going to see a disparity of that soon, but all in all, this is actually healthy. A takedown is healthy. I base my whole investment philosophy at our company and our firm on value investing and understanding cycles and swim with the tide and let the trend be your friend. So, you know, the bull market in equities, take the Dow. The Dow started in 83, it finished in 2007. We had an 87 stock market crash where the Dow dropped 22% in a day. Now, that looks like a blimp on the chart now when you look at the Dow, but in every long-term bull market, nothing goes up in a straight line, and investors must understand this. And what it's actually done is shaken the speculators out of the paper markets, and it's actually now starting to build more of a strong consolidation for those people coming in on the physical market.
All right, tied to all of that, your call on the US dollar. Where's it likely to go next? Because that's critical.
It is critical. In short term, I think there's a flight to safety in the US dollar. You know, the problems around the world, a lot of the focus is on other parts. Like Bernanke comes out and says economic data in the US is good. Well, let's have a look. There's nearly 50 million Americans on food stamps right now. When you look at federal debt in the US, it's $16.5, $17 trillion. But when you look at state debt, local debt, add in the unfunded liabilities, which is Medicare, Medicaid, Social Security, we're looking at $213 trillion, some top economists are saying. If interest rates just rose in America to 2%, America's busted. They can't even pay the interest on their debt. So the only thing that's driving markets right now is a bunch of liquidity. Now, if we have a look at the real economy, if we have a look at the Baltic Dry Index and look at shipping cargo, those levels are down to 2008. If we look at consumer deleveraging going on and the velocity of money, combine that with the copper price, which is contracting, the real economy is slowing. Right. The thing that's driving markets right now is liquidity. And, Carsen, can I just say, the same people out there that's saying that everything's fine were the same people that are saying everything was fine in 2007. All
right, well, if everything is fine according to those people, why is the Australian dollar obstinately above 103? Because you were just calling a pushback into appetite for greenbacks. That doesn't seem to me to suggest the A dollar holds this level.
Well, let's have a look at the Aussie dollar, though, because what a lot of people don't understand, in the GFC, Australia was the only country in the world to raise interest rates the way we did. We have one of the highest interest rates in the world. So what that's done is created a carry trade. So big institutions from the US and the UK can go to Japan, borrow money at 0%, and they dump it here. Hot money gets dumped here, so it shoots our Aussie dollar up.
That's only so good as we have our AAA status. David Murray from the Future Fund says there's a high chance we lose it very soon.
Correct. Couldn't agree more.
And at that point, your carry trade argument can't hold true.
I guess where I'm trying to say with this, with the gold, is you're holding gold against paper currencies. I don't really worry where the Aussie dollar, because every currency on the planet is falling relative to gold over the long-term charts. They're only rising or falling against one another. And we're in currency wars now. It's an expansion of currency wars, which then leads to tariff trades, capital controls, which eventually leads to currency crisis. And that's one of the big problems we've got out there.
Deutsche Bank yesterday saying the precious metal had entered, quote, a new reality. It may need to fall as low as 1,050 an ounce to bring its valuation versus other commodities back to historic averages. Is that a level that you're, I suppose, looking at seriously?
Look, my big thing to give some confidence back to where metal is keep coming back down to, I'm not worried about what the price is. I'm worried about how much stuff gold can actually buy with you, because where I'm looking at this is long-term, and when I say long-term, Carsen, I'm only talking between 2015 to 2018. So to be a value investor, a lot of value investors start getting nervous and start looking at physical gold as a trader. We're not looking at gold as trading. We're looking at gold as a hedge against paper currencies. So at the end of the day, if someone is negative gold, that means they're actually bullish currencies. Now, if we look at bullish currencies, the Aussie dollar's lost over 90% of its purchasing power since 1976. The US dollar's lost over 96% of its purchasing power since the inception of the Fed in 1913. And the British pound's lost over 98.5% of its purchasing power since the UK abandoned the gold standard in 1931.
Have you adjusted all those figures for inflation?
What's that, sorry?
Are they all adjusted for inflation, those figures?
Absolutely. When you start looking at the purchasing power, because people have to understand first what inflation is. Inflation isn't rising prices. That's the symptom of inflation. Inflation is expanding the currency supply. So when you've got more currency chasing less goods and services, prices go up.
Yeah, but they're not going up. That's the thing. In some of these markets, they are not. Anecdotally, they still fall, even in the United States, which is the greatest currency debaser of them all.
But I'd challenge that. Go to the grocery store, Carsen, and have a look at what it costs to buy a loaf of bread and a can of Coke.
I would go to you and say people are filling up till their trolleys are overflowing in Walmart.
One thing people have to understand...
Honestly, Brett, we must be clear on this. People are finding it more easy to afford than less in the US.
Well, the standard
Prices
of
are
living
falling.
the standard of living is falling, though. You only have to look at the real jobs data. You know, real unemployment.
I just must be clear on this point, though. If you're saying that an expansion of money supply ought to be meaning much more money chasing fewer goods, well, then arguably the price isn't reflecting that in the United States.
Okay, but there's a missing element, and the missing element is its quantity times velocity. So the other thing that mixes into that is velocity of money, and velocity of money is how quickly currency gets exchanged. So if I turned around to you and gave you $50 million right now, I've just expanded your currency supply. But the kicker is, if I told you to keep that in a safe deposit box and you can't circulate in the economy, then the velocity is zero. So we've got the largest amount of consumer deleveraging. People are nervous. They're sitting on the sidelines. They're closing their wallets. The problem is now savers are becoming losers because savers are being forced to be speculators when the majority of the industrialised nations are running at negative real interest rates. It's killing savers, so it's forcing the average person to become speculators, and now we're blowing up bubbles in other areas.
And Brett, I am being forced to call time on this. Thank you so much.
You're welcome. Thanks, Carsen.
Appreciate it. Brett Brocque from the Brocque Capital. Stick with us. We're back in just a minute.